Assalamualaikum warahmatullah and good afternoon. In this part, we'll be looking into the classified balance sheet. Okay, we have looked into balance sheet. We've understood that the balance sheet will show three main components of the accounting equation: the asset, the liability, and the owner's equity. All right. We have understood that balance sheet presents a snapshot at a point of time. It does not show a period of time. It shows at one particular time. So if we say balance sheet at 31st of October 2017, then it's showing what is the balance, the current standing at 31st of October, which may be different from 30th of October, which may be different on the 29th of October, which may be different from 1st of November 2016. Okay, so balance sheet does not show the performance of the organization for a period of time, but it shows the current standing in terms of asset, liability, and owner's equity at a certain date. Okay, we can understand the components of the accounting equation from the balance sheet. But if we classify the items in the balance sheet, we classify them further, then it may aid in the understanding, a better understanding of the financial position of the company. Okay, so there's a certain standard terminology in terms of how the asset, liability, and owner's equity are classified inside the balance sheet. Okay, so these are the standard classifications. So under asset, we can actually divide the assets into these four classifications. Okay, we have the current assets, we have the long-term investments, we have property, plant and equipment, we have intangible assets. All these are assets. Okay, and under liability and owner's equity, we can also divide them into three. We have the current liabilities, we have the long-term liabilities, and we have the owner's equity or the stockholders' equity. We will look into these one by one. Okay, so this is an example of the classified balance sheet. So this is derived from the same balance sheet. Is it the same one? No, it's a different balance sheet. Sorry, it's Franklin Company. We have looked into the Pioneer something in the previous videos. Okay, so this is a different company, but here in the balance sheet, all the accounts are grouped into the different types. The different classifications. Okay, so assets, we have four types of assets as mentioned in the previous slide. So there are the current assets, we have the long-term investments, we have the property, plant and equipment, we have the intangible assets. So you see here current assets. We will talk about current assets in the next slide. But here we summarize the accounts that fall under current assets. We have cash, we have debt investments, we have accounts receivable, notes receivable, inventory, supplies, prepaid insurance. Basically, in general, those that fall under current assets are our the company's belongings. These are the properties of the company that they expect will give them benefit within 1 year period. Okay, these are expected to change within 1 year. So after 31st of October 2017, within 1 year of accounting period, these are expected to change. Cash will change, accounts receivable will change. Okay, these amounts will be giving the company benefit within one accounting period. Okay, the long-term investments are things that or the properties of the company when the company invests. Okay, the company invests in some other businesses, okay, probably they buy stocks in other companies that they intend to keep for longer than one accounting period, okay. So stock investment, they invest in some other companies and they intend to keep the investments longer than 1 year, okay. So these are called long-term investments. And then they have properties that they own that is expected to give them benefit also beyond 1 year, okay. So we have land. So land, people don't buy land and expect to use the land within 1 year, okay. They expect to have the land for multiple years, maybe for 10 years, maybe for 30 years. So it falls under property, plant and equipment, where these things are expected to give benefit beyond 1 year. Okay, so we have land and equipment. It might be different if the company trades land. Okay, if the company runs business by selling and buying land. So land is a stock. It's an inventory for them. So land does not appear here. Land will appear under inventory, okay, under current assets, because they buy land, they expect to sell the land to get profit within 1 year, okay. But otherwise, this is land owned by the business for them to run their business, okay, for them to establish their office, okay. So this is under property, plant and equipment. So they have land, we have equipment, and we have the contra account of equipment, which is the accumulated depreciation for equipment. And finally, we have the intangible assets, which are assets but does not have a physical nature, okay. So for example, patents, okay. So and then the balance sheet on the liabilities and owner's equity side. So this classification will be firstly the current liabilities, okay. Starts off with the notes payable, the accounts payable, the unearned service revenue, the salaries and wages payable, and the interest payable, okay. So these are the current liabilities. Again, when we say current, it means that it is an obligation because it's a liability, is an obligation of the company to satisfy. They need to satisfy these obligations. They need to pay up for the debt within one accounting period, okay. When we say it's a current liability, it is expected to pay. They are expected to pay these amounts within one accounting period, okay. But when it is categorized under long-term liabilities, these are obligations that the company has to pay beyond one accounting period. So mortgage payable, a company might be liable to pay for mortgage for 10 years or 20 years. Notes payable as well. In this case, the company has notes payable that is due beyond 1 year, and the company has notes payable that is due within 1 year, okay. So although the name is similar, but the nature or the obligation to pay in terms of the period is different, okay. So one goes into a long-term liability, the other goes to current liability. And then there's the owner's equity, which is the owner's capital. So this is the classified balance sheet, where accounts are classified further in order to aid the understanding of the information users, okay. Okay, so we go a little bit deeper. We look into current assets. It says here that current assets are assets that a company expects to convert to cash or use up within 1 year or the operating cycle, whichever is longer, okay. So I was just talking about it in general terms. It is something that the company owes, that is something that owns, not owes. So something that the company owns, that the company expects to get benefit from it within 1 year or one accounting cycle, okay. Which is expected to convert to cash, okay. Because when we all these assets is expected to give benefit primarily in terms of cash, okay. it says here the operating cycle is the average time that it takes to purchase inventory, sell it on account, and then collect cash from customers. Okay, right. Okay, so these are the current assets. Usually stay in the order. Okay, so looking at Southwest Airlines Company balance sheet on the current asset side. Okay, we have asset, and under asset we have current assets. So these are the current assets. So these assets are things that the company expects to turn into cash within one operating cycle or within one accounting year, one accounting period. Okay, or whichever is longer. So they are expecting to get back on their short-term investments. They are expecting to get payment from their accounts receivable. They are expecting to sell off their inventories. All these within one accounting period or within one operating cycle. Okay, and usually the current assets is shown according to the easiness to convert them into cash. Okay, cash and cash equivalents, or of course, is the easiest to convert to cash. Okay, you can take your cash and give somebody and ask them to exchange for a different cash. Okay, you have 100 ringgit notes. You go to the bank and ask them for two $50 notes. Okay, it's very easy. Okay, but if you have inventory, you have your items that you want to sell. You go to the bank, you say, I want, you have an inventory, a product, $100 product. You go to the bank and you ask, can I have two $50 notes for this, in exchange for this item? They said they don't want to. So the current assets will show the in terms of the order here, in terms of the sequence, those current assets that are the easiest to turn back into cash, to the most difficult to be changed into cash. Okay, so these are the orders. Okay, short-term investments is quite easy to turn back into cash. Accounts receivable, you need to chase your customers. Sometimes they don't pay, sometimes they don't have enough cash to pay you. Inventories, you have to do marketing in order for you to turn back to cash. And then you have your prepaid expenses and other current assets. Of course, prepaid expenses, you won't be able to turn them back to cash, but you will get the benefit when the time passes. For example, if you have a prepaid insurance, you can. It's very unlikely that you sell back your insurance, but then you will reap the benefit from insurance when the time comes. Okay, so it's the most difficult to turn back into cash.